Okay, great. So welcome everybody. So what I wanted to uh, show you guys today is a strategy, a strategy related to capturing dividends via covered calls. And it's kind of a unique strategy that, most people know covered calls, but what we've been able to kind of do in one of our trading groups is to kind of build a strategy around buying a stock, selling the in the money covered call, and collecting the dividend for really nice returns and great downside protection, which is really come in handy in this kind of market where the more downside protection you have, the better. Would everybody agree with that?
Yes.
Okay, thanks. Okay, so let's go to the next slide. Okay, so let's talk a little bit about dividends. I'm sure the group, some of the group are really familiar with dividends, but I want to at least start off with the basics. So companies pay a dividend, which is just a return of capital or profits to their shareholders. And most companies do this. One, it attracts new, shareholders. People want to own a stock that pays a good dividend. There's whole strategies about owning dividend stocks because it's like a bond. So companies know that, and they're going to pay out dividends to show how healthy they are and to attract new buyers. So one of the questions that always comes up is when a company pays a dividend, say McDonald's pays everybody $1.50 a share dividend every quarter. So what happens to the stock price when it does pay out that $1.50 dividend? Well, most of the time the stock will go down in value by some amount around that dividend amount. It doesn't stay there, but it generally will take a small step back when it pays out that dividend. But the price of the shares is really going to be driven by the market price. So if it paid $1.50 dividend, it may start down $1.50 the next day. It may actually be up if the market's up. So it will impact the starting price, but the overall price is going to be dictated by the market, the buyers and the sellers. So the second kind of the most important thing about dividends, in my opinion, if you're going to sell covered calls, it's what strikes do we sell? Because that'll make a big difference. If you sell the right strike, you're going to able to get the dividend, but also have downside protection. And so that's kind of the whole basis of this dividend capture strategy. And there's also another strategy that I'll touch on that may be of interest to you guys as well. The one thing that you need to be aware of is if you own a stock and you sell a call against it, you could be exercised early. So, you might own, 500 shares of Apple Computer and sell a call. And if somebody wants that dividend more than you, they could take your shares away. So just good to know that exists and how to kind of prevent that from happening, or at least minimize it to a great degree. So really, in terms of dividends, there's really one main date that you want to be aware of, and that's the ex-dividend date. And the ex-dividend date is the date that you are no longer eligible to collect that quarter's dividend. So if a stock goes ex-dividend on Friday, you need to buy the shares no later than Thursday to get that dividend. Does that make sense, everybody? Is everybody familiar with the ex-dividend date?
Yeah.
Okay, great. So that's a key thing. You want to get the shares, and I like to get them as close to the dividend date so that I can set my pricing correctly. But you have to know exactly when it is, because if you miss it by a day, you don't get the dividend. And then the second date is the payout date, and that's generally 1 to 3 weeks after the dividend is declared. So those are kind of the main things about dividends. Any questions, or everybody good with that? Okay.
Do you still have to be holding the stock on the payout date?
That's a great question. And the answer is no. So if you bought the shares Thursday, got the dividend on Friday, you could theoretically sell the shares on Monday and still get the dividend 1 to 3 weeks later. Great question. So, so the one thing that we'll want to know is, well, where do we find these dividends? How do we know what's coming up to kind of build a strategy around them? So there's a ton of places you can find them, and they're all basically free. So you don't have to go pay money to find what a dividend calendar. I just did a quick Google and picked a few. MarketBeat, NASDAQ, investing.com, Fidelity has one. There's a ton of them. I like MarketBeat just because I'm used to using it. But any of these kind of calendars are great to locate to start your search for good dividend stocks. And once you've done, a quarter of dividend trading, the first quarter will come around and you'll have the same stocks again. So if you trade dividend stocks via covered calls, they come up 4 times a year. So here's just a quick snapshot of the MarketWatch X dividend calendar. And I just want to walk through a little bit of this just so you know what to look for. And they're all going to be basically the same. So it'll tell you, the name of the company, their stock ticker, whether the dividend is paid monthly, quarterly. 9 out of 10 are going to be paid quarterly. It tells you the amount and what is the yield of that dividend. And that's generally an annual yield. And then you'll have the infamous ex-dividend date. The record date is just the next business day, and the payout date. So that's the kind of information we need to start our search. And it'll be a full page list every week. And it'll show, good companies, high dividends, low dividends. It's all kind of going to be intermixed. And so one thing that I would say is you'll run across something called a special dividend. Has anyone ever heard of that?
Yes.
Okay. So what happens there is if a company has something going on, they may declare a special dividend. And what I've kind of found over time is that when you get one of these special dividends, it's anything but special to us option traders. What they generally have written into the rules are they're going to adjust your option price so that it negates that extra benefit. So I generally just skip over any special dividends. I did one recently, probably last year in Costco, where they gave a $10 special dividend. And what they ended up doing is they lowered the price of the your option strike by $10. So it totally negated the benefit. So on this, chart, you want to look for, what stock is it? What's the payout? What's the amount? And what's the ex-dividend date? So the earlier I mentioned that Market asked, that should be the case even for regular dividends? Yeah, you want to make sure that they're just a regular quarterly dividend, and dividends are priced into the option model, but I'm going to show you a little bit different way that I do them that you may benefit, or like to generate income with downside protection. So one of the questions, or one of the key things, is what strikes do we have to sell to collect the dividend? So I took this real quick snapshot of an option chain. I think this is ExxonMobil, because I use that as an example today. So ExxonMobil pays a dividend of 91 cents. So if you look, and it was trading at 114 when I took this snapshot. And if you look on the put side, it'll have all of what the strikes, what the put option credit is for all of the different strikes. So a great rule of thumb to know what strike to sell in order to collect the dividend is to look on the put side, and you want to make sure that the put level is greater than the dividend. That's going to give you, the opportunity to collect the dividend, qualify for the dividend. So for example, if you sold the at the money call over here and you looked over at it paid 278, which is way more than 91 cents. But you could actually go all the way down to 109, sell this call, and still collect the dividend. So that's kind of the methodology that I'm going to be talking about today, because the goal of this strategy, in my opinion, is collect the dividend, get a small net credit, and have great downside protection. So that, what strikes do we sell? We want to look at, what strike we're looking at, and then go across and say, is this greater than the dividend amount? And if it is, and you sell this call, then you're going to have a high probability of collecting the dividend. Everybody get that? If you have any questions and you want to because that's kind of one of the key pieces. So if I need to explain it a different way, or if you're all good, just let me know. You can just type in the chat, good or yes, that kind of thing. So I know that you guys are okay there. Okay, great. So that's, what strikes do we sell? We have to sell it enough so that whatever strike we sell is greater than the dividend. So I want to talk about 3 different dividend capture strategies that I trade pretty regularly. So Mark had a great question. He said, I get the rule, but I don't understand why this is, because if there's more time value than the dividend amount, then it's too costly for someone to execute, take it away from you. It costs them more than the dividend itself. So most of the time they're not going to, exercise their right to take that call if there's too much time value left in that particular strike. So hope that answered your question. So let's talk about the dividend capture trade. And this is a title we just came up with because it's a pretty cool way of kind of looking at it. So here's an example of probably a standard dividend capture trade. And so in this trade, I bought the covered call in CVX, and I bought the stock at 185.67 per share, and I sold the 11/18 177.50 call and collected $9.37. So one thing you'll notice is the stock's at 185. I sold the 177.50. So I'm already way out of the money and collected $9. Now CVX went ex-dividend on 11/17 and paid a $1.42 or $142 per 100 shares, which was an amazing 3.5% annualized return. So a lot of the energy companies pay great dividends. So that's the trade. We bought the stock, we sold the in-the-money call, and then we collect the dividend, or we are set up to collect the dividend. So if we're assigned early, meaning that if the day before it goes ex-dividend. Somebody wants to exercise their right to take my shares. I'll make a small net return in 10 days, which is a 25% annualized rate of return with 5% of downside protection. And what a lot of people say, well, what is downside protection? It just means how much can the stock move down and you still not lose money on the trade. The second piece is if we get the dividend, and we should get the dividend because the way we set the trade up, it will give us a 1.5% return in 11 days with about 6% of downside protection, which is a annualized to a 49% annualized rate of return. So that's kind of the like a poster child of the dividend capture trade. So any questions? Does that make sense?
Yes, I guess this would be preferable in a IRA account, I guess, with all the credits and the losses, and it could get
I think
complicated.
it could. I mean, I trade mine in an IRA, but you could trade it, either way. But I mean, they're eligible in pretty much any account, but they could go, in an IRA. I think makes the most sense. So Dwayne wanted to ask, how do you calculate the downside protection? You basically take the stock price less the credit you received, less the dividend, and that is your break-even point. So then I calculate the difference from the stock price to that level to get your break-even level. So it's just really how much can the stock move down and I still make money on the trade. Okay, so here's the mechanics. This is a pretty recent example. I think this trade is actually still on. It's on ExxonMobil. It goes ex-dividend on Monday, and it pays that 91-cent dividend. And so the ex-dividend date, like we talked about, is that we need to own that shares 1 day before it goes ex-dividend. So in this case, we have to own the shares on Friday the 11th, to get the dividend. And if it's not if we bought the shares on Friday and we still own them on Monday, we're going to collect that dividend. And we don't have to hold the shares. I think this was Dean's question. We don't need to own the shares through the payout to collect the dividend. We could theoretically close out the trade on Monday and still get the dividend. And then once it's executed, we manage just like any other covered call. So there's really not, once you get the trade and set it up right, there really isn't anything to do but just, watch it, expire. So that's kind of the beauty of the trade. And then, if you're not assigned, when do we close it? A lot of times I'll just let the trade expire. If I sold the 11.18 and I'm 6%, below where the price is, I know what I've already made in the trade, so I can just let it go. Or if I want to close it early, you certainly can, but you have to close the call first and then the stock, or do it together. But that's the only thing about closing them early. And I will do that, especially if, like, say it's already at my full price and it's 3 or 4 days early. I'll set an order to close it at whatever my short strike is, so that I can get out of the trade 2 or 3 days early if they'll take it. So that's the trade mechanics. I built a watch list, a spreadsheet, and here's the trade on, and I blew this up so it looks a little strange, but here's the ExxonMobil trade that we just walked through. The stock was trading at 114. I built a 8% exit level so that if I know if it drops below 105, then I probably want to think about exiting the trade. I sold the 110 call, used the 11.18. I got paid $4.75. I'll collect one dividend of $91, and I will make 1.5%, 5% downside protection, 50% annualized rate of return in 11 days. And here's my break-even point. So theoretically, you could divide this number by this number, and that is your downside protection. So that's how I calculate my rates of return, my downside, annualized. So what I'm really looking for is, at a minimum, I want to collect at least 24% annualized rate of return with about 5% downside protection. That's what I'm generally looking for on these trades. And then here is just, again, looking at that dividend. I sold the 110 call. So if I look over across to the put side, I can see it's clearly more than 91 cents. So with this trade, I would be set up to collect the dividend. So that's how I kind of set those up. So any questions about the dividend capture trade?
Hey, Brian.
Yes.
Mark Horner.
Hey, Mark.
Thanks for doing this. So how far out do you go with the call that you're choosing to sell?
Yeah, I mainly sell the monthlies. Because, a lot of times what you'll find on the weeklies is that they don't have enough open interest and the spreads are too wide. So like up until probably this week, I'm using November options.
Yeah.
But, starting about now, I don't want to be putting too many November 18 on. So if there's enough open interest, I may go out a couple of weeks before I start rolling everything over till December 18th.
Okay, great. Thank you.
Yeah. But the key thing is, if you're using week or even any options, you want to make sure you have really good open interest and pretty narrow bid-ask spread. So what you don't want to do is you don't want to buy something that has, like down here, has 21 open interest. But these are, the ones that I primarily trade are going to have pretty good open interest.
Got it.
Great question.
Yeah, thank you.
So that's the dividend capture trade. And I love that trade because it gives you a really, nice rate of return with downside protection. So, and you could do this exact same trade if you wanted to sell the at the money call. You could, calculate what your rate of return is. What you don't get is, what if the stock dropped to 110? Because remember how I said a lot of times it'll drop by the amount of the dividend. So if it starts at 114, it may open the next day at 113. Then you're already $100 underwater if you just do the at the money call. Okay, so the second strategy I wanted to talk about is a trade that we call it the bond substitute trade. And this was kind of, I had a client that was talking to me about really ultra conservative option selling, and we kind of were working on it, and it's almost, and the reason I call it a bond substitute, it's almost like buying a bond. It's going to pay you a really nice rate of return, but unbelievable downside protection. So in this particular strategy, what we're looking for is we want to be able to buy the shares and sell a really deep in the money covered call. And our goal in this trade is we want to earn an annualized rate of return of between 8 and 12% with at least 20% downside protection. So it's a strategy that just really, if you want to have money that's just earning a really nice rate of return with unbelievable downside protection, this is a great strategy to use. And again, I call it the bond substitute because it's a low risk strategy that generates income kind of equivalent to a really good bond, even though most bonds don't pay 8 to 12%, not yet at least. So here's here's a trade that I did using this strategy. And this is a pretty recent one. So this was in VLO. And so I bought the stock at $126 a share. And this was done probably like the early November. So, and I sold the March 100 calls. So I'm going out 4 months and selling the 100 calls. So you can see, you know, I'm buying it at 126. I'm selling the 100 call, and I'm collecting $30.53 per share, or $3,000. So I own the shares and I sold the call. So Valero goes ex-dividend on 11/16 and pays a $98 dividend, which is about a 3.5% annualized return. So that's almost like a bond by itself. And then I know that based on the fact that it's a quarterly dividend, 11/16, the next one's going to be around, 2/16, I should say. So every 3 months that bond is going to be, or that dividend is going to be paid. So I sold the 3/17 so that I will have a great chance of getting both dividends. Everybody see that? And
Yeah.
so if I collect both dividends, and I should, based on what strike I sold, it will pay me a 6.6% rate of return in 135 days with 25.76% of downside protection, meaning the stock could drop under 100 because I've already sold the call and I'll collect the dividend before the trade would lose money. And it's an annualized rate of return of 18%. So, and my break even here is $93.64. So in order for this trade to lose money, the stock would have to drop from 126 to 93. So that's kind of why I like this trade. I think I help my father-in-law with his account, and I just loaded it up with these bond substitute trades, and he's a happy camper this year. Any questions about the
How did you pick the 100 strike price? Is that based upon that dividend analysis that you talked about earlier?
Right. So what we're looking at, we want to make sure we sold two things. We want to make sure we sold the we use the strike price or the expiration that we will collect both dividends. So we want to be after 2/6. And probably the monthly in February is probably too soon. We'd probably lose that second dividend. So that's the reason I used March. And then I sold the 100 so that it would be well over the 98 cents on the put side. So it's set up to, collect both dividends and go away, in March for a profit, and we can deploy the capital. So, and Mark, I'll walk through the return. It's actually on my spreadsheet, so I'll show that to you. But basically, it's going to be what you pay for the stock, the net cost, because you're going to receive the dividend. I mean, you're going to receive the credit, and then you add in the dividends and divide it by your net cost, and that's how you calculate the return. And then it's annualized based on a 365 days. So if I hold it in this particular case, 135 days, which is a pretty long period of time, it's 6.6% divided by 135 times 365. So that's how you come up with the annualized. So the trade mechanics of this particular strategy is one, I think in dividend, what I see a lot of times is people chase great dividend returns. They'll say, oh, this stock pays a 10% annualized rate of return, which may not be a good idea. If it's not a good stock, you don't want to be buying the shares and trying to collect the dividend. There's plenty of good stocks out there that pay great dividends. You don't have to chase junk. And a lot of times there's no difference between, you can use this strategy on a $25 stock or a $250 stock. It works the same. So, but what I always do is I kind of go through a screening process to make sure that it's a solid stock and it's one I would want to buy. Even if I'm selling the in the money call, I don't want to pick an illiquid stock or a really bad fundamental or technical stock. And so what I wanted to do is kind of walk through the dividend the bond substitute trade using ExxonMobil, if that's good with everybody. So again, this one pays that first dividend on 11/11. The second one would be 3 months later. So, and it pays $91. So so I highlighted here on the spreadsheet so this was a couple of days ago. The price was 114. So in this particular case, I could go out to March, sell the 87.50 call, collect $27.95 plus 2 dividends because I'm collecting 2 dividends. So this would be like a rate of return of 3.8. So it's an 11% rate of return annualized with 26% of downside protection. So, if ExxonMobil drops 26% in the next, 120 days, we got probably bigger issues to worry about than the price of this stock. So, so that's kind of the setup and how the numbers run. So the only thing I double the dividends because I'm going to collect it twice. I sold the dividend beyond that second ex-dividend date, and I look to go as far in the money as I can so that I can collect both dividends and have a ton of downside protection. So that's from my watch list. And here it is on the option chain. So here's the March option chain, the 87.50. And if I look across the aisle here on the put side, it's more than 91 cents, meaning that I will collect the dividend the first time. And as long as this strike stays above 91 cents, I'll get the second one. If it drops below 91, I'm at risk of being assigned a month early, but it still ends up being a nice rate of return. So there's really no downside. If you get exercised early on the second one, it's still a great rate of return, and you can redeploy your capital on another dividend stock. Does that make sense, everybody?
Yeah, makes sense. Would you ever adjust the call if it does drop below the 91?
Yeah, that's a great question. Yes. So if, for example, say I'm on February 1st and I'm looking at my stock, and now I look over here and this is 85 cents. I'm at risk of not getting the dividend. If I want the dividend, I could roll this call out a week and make sure that the new corresponding put is more than 91 cents.
Got it. Thank you.
That's how I would do that. Yeah. I mean, one of the things you want to do is in my opinion, if you do this strategy, you want to know if you're going to get the dividend or not. So if you know it's going ex-dividend in a couple of days, you want to be looking to see what that option chain looks like. So, because sometimes you go, I really want this dividend, so I'm going to adjust my, my strike. Or you could say, you know what, I don't care. Either way, I still made a nice profit. But you want to know, you don't want to be surprised in the morning. So
Yeah,
any questions about, do y'all like that bond substitute trade?
yeah, for sure. It seems like it's basically the same trade. You're just going further out to get 2 dividends. And
yep, that's exactly. I tried to use this for this purpose. I used the same, stock so that you could kind of see how, the different strategies kind of work. Okay, so okay, very good. So the last strategy is kind of a really different strategy, in my opinion. This I call this strategy the dividend scalp. I was talking to somebody and said, us option traders, we have to have a cool name for every strategy. So this is the dividend scalp, and it's the same strategy, except Now we're going to sell a call that's set up to be taken away early. And that sounds weird, but what we're trying to do is generate a quick profit in a day or two and have our stock taken away, but we can make a nice rate of return and redeploy our capital in a day or two. So that's kind of the whole idea of the dividend scalp. So again, it's a strategy where we set the trade with the intention of getting assigned away before collecting the dividend. So we'll set it up to say, wait a minute, I got a really good trade, good dividend paying trade that's on Friday. What if I buy it, sell a call that I'll get taken away? What kind of rate of return can I get that on that in a day and a half with a lot of downside protection? So its goal is to generate profits, not to keep the stock. And so here's like an example of one that we did in Citigroup. So we bought the shares at $44.35 a share. I sold the 11/18 42.50. So it's pretty close to the money, and I collected $2.24. So Citigroup went ex-dividend on 11/4 and paid a really nice dividend of 51 cents, 4.83%. So if I bought the shares and sold this call and got assigned early, I would make like a 0.93% return in 2 days with 5% downside protection. So it's a good way to, if you have, trading capital and cash and you want to make a nice quick return with really nice downside protection, that's what this strategy does. And if I got the dividend, now the return would be 2% in 15 days or 52%. So, either way, I'm pretty happy with the trade. If they take it away, I'm okay. If they give me the dividend, I'm okay holding it a little bit longer for a higher net, but a lower annualized. So, but 52 versus, some crazy number is what the dividend scalp is all about.
And you picked that because the dividend was coming up and within a short period of time?
Yep. So the dividend was coming up in a few days from the day I put the trade on. Probably did this on about 11/2. So I was looking for a strike that I could sell on the call side where the across the aisle on the put side was less than 51 cents. And let me show that to you in just a second. So did that answer your question, Bud?
Yes.
Okay,
Yep.
Great. Any other questions before I move on? Okay, so what we're looking for here is a stock that's paying a really nice dividend, because it doesn't really work on really low, like if it's only like a 1.5% dividend, the scalp generally doesn't work. So you want to look for something probably 2.5% or higher annualized rate of return. Best if it's 3 or 4% and a stock that is still a good stock. And then we basically are going to look to sell. What call can I sell that is slightly less than the dividend? And then we calculate the rate of return based on the ex-dividend date. So even though I'm selling using like an 11/18 date, to calculate my return on the scalp, I use the ex-dividend date because that's the day I'd actually be taken out early if I don't get the dividend. Does that make sense? That's a little bit confusing. So let me show that to you. So here's the same ExxonMobil trade, $114. In this particular case, I have sold the 97.50 call. So I went, so I wouldn't get the dividend. And because I went further in the money, I will collect $16.90 credit. I don't get the dividend. I'd make $40 per 100 shares in 2 days. So it with 14.8% downside protections, meaning that if I bought the stock and the stock dropped 10%, I still wouldn't lose money on the trade. If I didn't get the dividend, I would be taken out in 2 days, 75% annualized rate of return. So that's kind of the benefit of the scalp trade. Any questions? Y'all like that strategy?
Yeah, it's interesting.
Yeah. So
Very
here's what it looks like on the option chain. So here I chose the 97.50, and that's where I calculate how much I'm going to get. And if I look across the aisle here on the put side, it's in the 70s, right? 73 to 77. So it's less than the 91 cents, meaning that I'm at a really high probability of being exercised early. There's no time value in this strike that's worth more than the $91. So that's why, you set this up knowing that somebody is probably there's a really good chance someone's going to take that away from you in a day or two if you set it up right.
Brian, would this work particularly well on some of those high dividend junk stocks that you referred to earlier, where really you don't want to keep the stock, but you could capture a...
Yeah. Here's my only hesitation about that, Bud, is that even like if I sold this 97.50 strike, I may wake up the next day and still own the shares. I shouldn't own the shares, but nobody exercised it early. So I still own the shares. I get the dividend, but if I'm doing that on a really terrible stock just to get scalped, and I don't get scalped, then I'm stuck with the stock. So I would probably avoid, I wouldn't buy shares in bad stock just to scalp the dividend.
Yeah. Good explanation.
Okay. So, there's plenty of good ones out there. If you look up like the dividend aristocrats, you just Google, best, high dividend stocks to own. That's a great starting point. So in summary, trading covered calls around dividends, in my opinion, is a great way to kind of beef up your returns. But if you sell the in the money covered calls, it's a great way to get a lot of downside protection. So a lot of times if I'm have a 10% downside protection and the market sells off 2%, I'm okay, for the most part, and so as long as I don't get below that deep in the money call, I'm good. And if I collect the dividend, even better. And really, all three strategies are pretty good strategies to use. I would say the dividend scalp is probably the hardest to execute because a lot of times you're trying to, collect a narrow window on how much you're going to collect. So sometimes they're hard to get filled. But what I'll do is if I see a great dividend scalp at the beginning of the day, I put the trade in at the price I'll pay for it and just let it go. And if it fills, it fills. If it doesn't, I'm okay with that. So that's my recommendation on the scalp is don't chase it because, if you move it up a dime, then your return is really diminished. So you want to keep, get it for what you need to get to make a great return. And then the dividend capture and the bond substitute trade are really good strategies to do as well. Any questions? Has this been helpful for everybody?
Very helpful. Thank you so much for taking the time. It's great.
You're welcome. So let me just, okay. If you want to write down my email address, brian.terrycfp@gmail.com. If you want to get a copy of the slides, I will post the recording on the YouTube channel. But if you want to get just a link to it, I'll be happy to send you to that as well. And I do have a website where we have a small private trading group that trades these strategies. So if you want to check it out, it's conservativecoveredcalls.com. And So we do this. This is one of the main strategies we do, and you're welcome to kind of check it out if this is of interest to you. So okay. So any final questions? Okay, great. So I'm going to stop the recording.